All right, we're on Chapter 8, Question 13a. All right, so in this question, we have Zipper Company. They have a fiscal year end of December 31st. The company sells one zipper called the Z Plus. On January 1st, Zipper had 20 units inventory with a cost of $20. And during the year, 65 units were sold, and they used periodic inventory system, which means they only update their cost of goods sold and their inventory balances when they actually count or record the transactions for the month or year. In this situation, I will start with determining the weighted average cost if they use that method, and then we'll go through the first and first out. We'll follow that by a specific identification. So we are told about a number of purchases. Okay, so we have a number of purchases for this organization throughout the year. We had 20 units. Okay. They purchased 30 in February, 15 in March, etc., etc. So their total value of their inventory was $4,245. Under the periodic inventory for weighted average cost, their sales would determine the fact that they sold 65 units. The average cost is determined by taking the value of inventory divided by the quantity of that said inventory for a total unit cost of $26.53. Giving a total value of their COGS, their cost of goods sold, being $1,724. This would then leave a balance of 95 units for a value of $2,521. The next situation says, let's assume FIFO, first in, first out. So for these 65 units, we actually need to break it down into three different components, because we will sell the first 20 units towards the 65, the next 30, and then 15 more for a total of 65 units. We will pull the cost from those buckets of activity from each one of those items, being $20 for the first bunch, $22, then $25. Total value of our cost of goods sold would then in this situation be $1,435. The balance of our inventory we would need to track by the different purchase lots. So we had a lot of 30 at 27, 40 at 30, and 25 at $32. So our value of our inventory at the end of the year would then be $2,810. The next step of this problem says use a specific identification. So it says that we did the following sales of 65 units on these 5 different dates. And those dates are attributed to the date of the purchase of the items. So for the sales component then, we need to record each item against the bucket that those items were purchased from. So we sold 10 out of the 65 units from the January 1st opening balance, so 10 items are at the $20 cost. We sold 5 out of the February 20th batch, so we have 5 at $22. 15 from the March 15th at $25 cost each. 20 units from the June 10th at the $27 cost each. And 15 from the September 30th batch at $30 each. The total cost of goods sold in this situation will be $1,675. Our balances then need to be carried forward for each batch item until the balance is 0 for that component. So our opening balance of 20 units less the 10 sold gives a 10 closing unit cost of the $20 unit items. So our value of our total inventory after going through each purchase lot will be $2,570. All right, so the last part of this problem says which method will result in the highest or lowest profit. So for this problem, what you need to do is look at the cost of goods sold under the 3 different scenarios. The cost of goods sold under weighted average, $1,724, FIFO, $1,435, and specific identification being $1,675. So in this situation, the highest profit means we need to have the lowest cost of goods sold. The result of that is the FIFO methodology. The lowest profit means we have to have the highest cost of goods sold. And in this situation, that would be the weighted average cost. I hope you found this helpful.